Are students too overconfident to diversify their investments? Imagine thinking you can pick the best stocks every time and ignoring the idea of spreading out your money. That's what many young investors do, especially students. Research shows that students tend to be much more overconfident than older investors. They believe they know more than they actually do, which can lead to risky choices. Freshman students, for example, are often the most overconfident, feeling they have a strong grasp of investing when their actual knowledge is limited. This overconfidence can cause students to concentrate their investments in just a few stocks instead of spreading their money across many different assets. They might think they can pick winners and avoid losses, but the truth is no one can predict which stocks will perform best. Diversification benefits come from spreading risk across different investments, so if one stock drops, others might rise or stay steady. Young investors often trade excessively because they believe they have special skills. They might buy and sell stocks frequently, thinking they can time the market better than others. But this can lead to higher costs and lower returns over time. Many students also overestimate their financial knowledge. For example, a large percentage of young investors rate their understanding as high, but when tested, they often struggle with basic facts about investing. Part of the problem is that partial financial education can boost confidence without giving students the full picture. They learn some concepts but not enough to understand the risks involved. This makes them more likely to ignore diversification and focus on individual stocks they think will outperform. Gender differences also play a role. Men tend to trade more and take bigger risks, which often results in lower returns. They are more likely to concentrate their investments in small, risky stocks rather than diversified portfolios. Young men especially tend to believe they can beat the market, but this overconfidence often leads to poorer results. Since students have not yet experienced market downturns or learned from mistakes, they often overestimate their ability to succeed. Their brains are still developing, making them more prone to overconfidence than older adults. This can also make them more vulnerable to scams, as they believe they can spot frauds easily. Financial education can help, but only if it emphasizes understanding your own limits. When students learn about risks and the importance of spreading out investments, they can become more realistic about their skills. Exercises that make students think about past mistakes or consider what could go wrong help them see the value of diversification. In the end, overconfidence clashes directly with the idea of diversification. Believing you can pick winning stocks all the time leads students to concentrate their money, which is risky. The smarter move is to spread investments across many assets. Overcoming overconfidence and embracing diversification can lead to better long-term results and less stress about market ups and downs.